This week on the 1 Minute Retirement Tip podcast, I'm talking about Joe Biden's tax plan and its impact on investors. Now that Biden is in the White House, now that Trump's cologne has worn off of the curtains in the Oval Office, and he's starting to make plans and talk more about these things, we kind of have a sense based on what he talked about on the campaign trail and what he posted as his tax plan, what that will look like. And now that Congress is Democrat, we're probably going to see a lot of these proposals get enacted into law, but none of them are law yet, and there's no guarantee that they will. So I just want to make that very clear that as of this recording in February of 2021, none of this is actually tax law yet. Today I want to talk about some of the key things that I covered on the podcast this week, which is Biden's tax plan for capital gains, for big changes to IRA and 401k, and how those contributions, the deduction that you get on those, that's probably have the biggest kind of widespread impact on Americans as it relates to your investment portfolio. And then I'll talk a little bit about the impact on inheritance taxes and 1031 exchanges for property. That's going away. And then let's talk a little bit about how likely this is to actually become law. And then lastly, I want to just take a look at the overall impact for stocks specifically as it relates to your portfolio. But before we get into this week's topic, I just want to introduce myself. My name is Ashley Micciche. I'm the host of the 1 Minute Retirement Tip podcast. Anywhere you listen to podcasts, you can find it. But if you have an Alexa device, you can subscribe to it on your flash briefings, which is a really cool way to get news and weather and update. And you can also add my tips, quick little retirement tips to help you on your path to retirement. So all the links to subscribe are in the description below. Let's get into this week's topic. Okay, so first of all, Biden's tax plan on capital gains. Now, what you need to know here is that the cutoff in the proposal is $1 million of income or more. So if you make less than $1 million, the way the proposal is currently written, it's not going to impact you. But what it does is if you have over $1 million of income in a given year, any capital gains that you realize for that year, the tax rate on those is basically going to double. So right now, the most I believe you'd pay in taxes for capital gains, no matter what your income, is going to be just shy of 24%. And that's pretty low by historical norms. But what the Biden proposal aims to do is to raise that to whatever your income tax rate is. So the favorable tax treatment on capital gains is going to go away for those highest earners. And then on IRA and 401k accounts. So this is one of them that is really difficult to kind of wrap your head around and explain and think about, okay, how does that impact me? Well, this is going to be the one that's going to have the most wide sweeping changes. What it does is it effectively creates a tax credit. So right now, if you could make a contribution to your 401k account, you get a tax deduction for that contribution. Unless you do Roth, and that's a whole other matter. But let's say you do a traditional 401k contribution. So the higher your tax bracket is right now, so if you're in one of the higher tax brackets in the 20s or 30s, and that's your effective tax rate, you benefit substantially by getting that tax deduction on those 401k contributions. But what this tax credit does is it kind of levels that deduction out. So you're going to get a 20%, 20.5%. Why do they use half? They always use half numbers. It's silly. Okay. 20.5% credit, it's a 26% deduction credit that amounts to a 20.5% deduction. See how this is confusing? Okay, so all you need to know is no matter what your income is, if you make $1 million a year or $10,000 a year or anything in between, every dollar that you contribute to your traditional IRA or 401k account is going to basically provide you a tax deduction of 20.5%. So if you make $100 contribution, your tax benefit is going to be about $20.50. The goal here is that to provide a bigger tax deduction to lower income earners. And that's the purpose, I think, behind what they're doing. But I think why I give this one a thumbs down is because people who are in those lower tax brackets, if you don't pay anything in taxes, or if you're in the 12% bracket, if you make $40,000 a year in household income, the reason why you're not contributing to your 401k is not because the tax deduction is not big enough. The reason why you're not contributing most likely is because you simply cannot afford to defer any income. You need every single penny of your paycheck. And so what it'll do is it's going to disincentivize people who are contributing currently, and or maybe steer them into the Roth instead, which that's fine with me. I think more people need to understand, appreciate, and contribute to the Roth anyways, especially in the 401k where you don't have those income limits. But it's not going to incentivize any additional people in those lower income tax brackets to contribute to the 401k. I just don't see that happening. Um, and then a couple other changes. One is on inheritance taxes. So it eliminates the step up in basis. If let's say I bought Apple stock back in the 1980s and I die, I have, maybe millions of dollars in a particular investment. I die. What happens is that cost basis, all those gains that I had, it's stepped up as of the date of death. And then when my children or my heirs sell that, they don't pay taxes on that original gain. Sorry if you can hear a little baby. My 4-month-old is squirming around on the floor over there. So they're not those little Theodores who inherits my IRA, or not my IRA, but my stock account. He's going to get a step up in basis, and he could turn around and sell the stock tomorrow and pay no gains at all. So they're eliminating that, as well as kind of a similar provision with being able to defer the gains on 1031 exchanges for property. So let's say you have a rental property, you sell that, you want to buy a new property, you don't have to pay taxes on selling that property as long as you kind of roll that into the new property that you own. It's called a 1031 exchange. And that's going to be eliminated as well if these proposals become law. So lots of changes impacting a lot of people. And which brings me to the next point, which is, how likely is it that some of these proposals are actually going to become the law? Well, I think it's pretty likely, considering that we have a Democratic Congress. Biden is not going to have too many things in the way. What am I looking for? Roadblocks in order to get these things through. And it's going to raise a lot of revenue. They want to raise taxes. It's going to raise, I think, the estimated amount of revenue that all these tax changes combined. I didn't talk about all of them. There's corporate taxes as well, but all of the combined Biden tax plan changes are estimated to raise, I believe it was $3.3 trillion over the next 10 years. So a lot of raising revenue, bringing in more money for the federal government. And they like raising taxes, and they like having more money. And in general, not just Democrats, but politicians in Washington in general, they like having more money to play with. So I think it's really, really likely. However, because of the pandemic, I don't think it's a good PR move for them to raise taxes this year until we're more kind of out of the woods with the COVID pandemic. I really don't think we're going to see tax law changes, like wide sweeping tax law changes. I think what will likely end up happening is 2021 will remain the status quo. And then next year, if the economy has recovered sufficiently, then we'll start hearing more details about this becoming law and things getting signed into law, sailing through Congress, etc. So the takeaway with this is that I think 2021 is your last year to take advantage of the very favorable very favorable tax climate. If you look back historically, if you have a good historical understanding of taxes in the United States, they are very, very low by historical norms right now. So I would be doing tax planning. If you have highly appreciated assets, if you have a larger estate, if you are a millionaire, basically, or you have a high income, a lot of these tax changes are going to impact you. So now would be the time to talk with your tax advisor, talk with a good tax attorney who can help you structure things in order so you don't get blindsided by this. Or you could just, wait another 4 years, do nothing, and see if, a changeover in administration changes all of this together. We saw the Tax Cuts and Jobs Act, taxes went way, way down. Now they're going back up. So there's this kind of like seesaw effect depending on who is in the Oval Office. All right. So the last impact that I want to mention, I'm not going to spend much time here because I'm already past 10 minutes, is what about your stock portfolio? So, if corporate taxes go up, which is much of what this tax plan is around, is raising the corporate tax rate. Well, that's going to impact companies that you invest in your retirement accounts. So, technology companies, healthcare companies, all of these like S&P 500 companies, they did a study, and they looked at, I believe it was Bank of America who looked at this and dug into the numbers on this, but they estimate that the S&P 500 earnings impact. So earnings impact. So taxes go up for corporations, it takes a hit to their bottom line, and it impacts their earnings, reducing them. So the biggest hit sector in this was technology. They estimate that the impact on earnings would be down about 9.2%. We also have healthcare, communication, consumer discretionary, and financial sectors that were all between like 6 and 8% drop in earnings. And if their earnings decline, and they don't have the growth to prop it up, or they can't increase the top line revenue to prop it up, that does ripple effect down into stock prices and into your portfolio and performance of the fund. So it remains to be seen, however, how that ripple effect happens. It doesn't always happen necessarily how you think it will, but changes in tax laws change incentives, it changed pricing structure on companies. So you may see it in other ways too. Like if you think that corporate tax increases will not impact you, think again, because it trickles down in the form of higher prices. So keep that in mind as well. If you're thinking, it's not going to impact me too much, it's likely to impact you regardless. The most important point here, however, is to realize that 2021 is maybe your last opportunity for several years, 4 more years, 8 more years, who knows, to do some serious tax planning. And, maybe you decide you want to accelerate gains or selling property, or maybe you do a Roth conversion this year. Like, these are all things to seriously consider depending on your situation. All right, that's it for today's live stream. Hopefully, after watching this video, you have an idea of the proposed tax law changes, how those are going to impact you specifically as an investor. Now, there's a lot to dig into. I didn't talk about everything, but these are the areas that I think are key to understand as an investor and how the proposed tax law changes might impact you. And of course, if you like this video, be sure to subscribe. And if you like listening to podcasts, check out my podcast. It's available on all the most popular podcasting platforms. Thank you so much for listening and watching. My name is Ashley Micciche, and I hope you have a blessed day.